Welcome, Caroline. Great to have you on our asset owner interview. Thank you for finding the time to be with us.
Not at all. Pleased to be here.
Would you mind introducing yourself and your role at Railpen and highlight the organisation's key characteristics and how these may differ from other UK asset owners?
Of course, I am head of investment stewardship and co-head of sustainable ownership at Railpen. So I co-lead the sustainable ownership team, but I also am responsible for leading our work on proxy voting and engagement and public policy and thinking about managing bottom-up ESG risk and top-down ESG risk as well. We manage around £35 billion on behalf of around 350,000 members of the UK Railways pension schemes. And we have many open defined benefit sections. So we are a very growth-oriented investor. We also unusually manage much of our particularly listed equity portfolio internally. So we have a hybrid investment arrangement. And that combination of our scale, we are a large asset owner, as well as internal management, and we can take the voting decisions ourselves, and we have those direct relationships with companies individually as well as working with others, I think puts us in a really powerful sweet spot when it comes to stewardship activity.
Great. I'm going to put you straight on the spot with our first question. So what is systemic stewardship and what role does it play in Railpen's overall approach to stewardship?
Of course, Railpen considers ourselves to be a universal owner of assets, where we have this globally diversified portfolio that really is a slice of the global economy. And so our portfolio is affected by big picture or system-wide risks like biodiversity or climate change or shareholder rights or workforce treatment. And so when we talk about system stewardship, what we're really talking about is our approach to trying to influence the wider systems in order to achieve better outcomes, better financial outcomes for our members. We've been doing system stewardship for many years, and that includes always having had a dedicated public policy work stream as well as part of our system stewardship approach on financially material issues. And that financial materiality is really important to us and the trustee.
Okay, so noting the importance you place on corporate governance to long-term value and success of investees, how does Railpen's governance structure inform investment stewardship priorities?
We are very lucky in that we have a very clear delegated mandate from the trustee as expressed through the investment beliefs that the trustee shares with Railpen, which is that incorporating and acting upon financially material ESG issues, including climate risk, is an important driver of investment returns. So I mentioned previously how that financial materiality is key. And in terms of our stewardship work specifically, obviously that comes very clearly from the acting upon ESG factors in the shared investment beliefs, but we also have set out in the Statement of Investment Principles the trustees' very clear stewardship priorities, including system-wide stewardship priorities. And of course, we make sure that we regularly engage with our trustee as our client on what we're doing. We seek their views on particular issues that we're thinking about championing or taking forward. And it's really important for us that we keep them informed and that they have the tools that they need to be able to challenge us effectively. And that key focuses on what is good for members. They take a very member-first approach, and accordingly, that drives everything we do in the stewardship work here at Railpen.
Why are the chosen three themes of the SFM engagement plan so important to long-term investors? And what is the overall theory of change behind it?
So SFM is one of our four major themes. It stands for Sustainable Financial Markets. And the other major themes that we focus our resources on are climate and nature, and also worth of the workforce, human capital treatment, and responsible technology as well. And for us, when we thought about these big themes and how we sought to try to focus our efforts, we thought about those things that were most material to our particular slice of the global economy, where we could have the most opportunity for influence and where influencing was most likely to have a positive impact for financial outcomes for members. And so we chose a couple of sub-themes within each of these four categories. And for sustainable financial markets, that's shareholder rights, including unequal voting rights, it's board effectiveness, and it's also a high quality external audit. And we chose these because the evidence showed us that actually these three pieces were fundamental drivers of healthy financial markets and resilient economies, the resilient economies that we need in order to achieve good outcomes for our members. And if any one of those pieces goes awry, then really our portfolio, everyone's portfolio, is in big trouble. We also overlaid considerations around what was happening in the wider environment on these three issues. And for instance, there's been an awful lot of policy activity on shareholder rights and dilution of shareholder rights worldwide. We know that board effectiveness, even at some of the really large, well-established companies, is not working as well as we might wish it to work. And we also know that external audit is not a very sexy topic, even for sustainable investors, for governance-focused investors. And yet investors being able to trust that the financial accounts of a company they invest in or are going to invest in represents a true and fair view of that company's financial health is fundamental. And there's work that still needs to be done to improve audit quality. So that's the other reason why we decided to focus on that area specifically.
I mean, you just touched briefly on communication, so I'm guessing that it's quite hard pushing that across to members and trustees. Do you have to tailor your tactics to each of the individual themes?
Absolutely. So it will depend on what the opportunities are for influence. And when we think about where we can have most influence and which tools are available to us to use, we think about which are the key jurisdictions where influencing on a particular issue might really be impactful. We think about whether or not there are any policy hooks that are coming down the track that we can take advantage of. We think about what we call systemically important companies on particular issues, which are those companies where if we can influence them to achieve positive change on a particular issue, because they are so high profile, market movers, other companies are just looking to them in terms of how they might model their own behavior, that positive influence will have a disproportionately beneficial ripple effect across other companies in the same jurisdiction or sector. And, we do think generally about what is the right proportion of policy work to company-specific work as well. So, for instance, on the shareholder rights piece, we do quite a lot of policy work there, because whether or not investors can have equal voting rights, or whether or not the shareholder resolutions process in certain jurisdictions is really respected by policymakers is a very live topic at the moment. And there are certain jurisdictions where that is more pressing for us and for others than elsewhere. So we focus on those jurisdictions. But when it comes to an issue like board effectiveness, for us, that's really a company level conversation, because we recognize that every company is different, and actually being able to work in direct partnership with a portfolio company as an investor on something that they really care about and we really care about, we think can be most impactful.
So, I mean, I guess across those themes and working with different investor coalitions, there must be some lessons that other asset owners could learn. I'm sure you've had some challenges, benefits, and there's an optimal way forward. I wonder if you could just share a little bit about that.
Of course. So, we really believe in the power of investor coalitions, or indeed coalitions of like-minded individuals across the ecosystem, to try to achieve change, because it can amplify the work that you're doing. You have a critical mass of investors speaking with one voice. And of course, like any cognitively diverse group of individuals and organizations, being able to have different voices feeding in with one shared objective, but on the policy paper you're producing or the engagement plan with certain companies that you've been pulling together, makes everything so much better. And I should point out that we believe in collaborating with investors, but also with membership associations. So coalitions like the Investor Coalition for Equal Votes was co-founded with the CII. We've got several other investor organisations as part of that. Governance for Growth Investor Campaign, again, that's got a policy angle to it. So we wanted to work, and we do work with ICGN and PRI and Pensions UK and so on. And we are really pleased that we can bring these people together and benefit from their insights and expertise. There are, you're right, challenges in running an effective coalition. And by the way, I'm not saying that we've got it cracked at Railpen just yet, but we do think very carefully about this. The first is that people are really busy. So you have to make sure that if you're setting up a coalition, you can dedicate the resource to it yourself. And other resource and inputs from people are always really appreciated, but you can't necessarily count on that. And you also have to be prepared to make as compelling a sales pitch to people as possible. Why is it the case that joining your coalition is going to achieve impact on a material issue that will help their stakeholders and their members as well? I recognise that with a lot of the antitrust activity and suspicions happening in the United States as well, that there are concerns amongst some of the more conservative-minded investors around potential antitrust accusations when it comes to joining coalitions. So one of the things that we have always sought to do, and we continue to refresh the advice on this that we receive, is get external US legal advice, internal legal advice, to make sure that we have the practices, the documentation, the approach for all of our coalitions that mean that we won't be running up against any of these antitrust concerns, and that we minimize political risk as much as we possibly can. And then the final thing I would say is that it's when you have a large group of organizations, each one having their own governance practices and sign-off processes, it's a challenge to keep things nimble and adaptable. And of course, in an ever-changing news and political and company environment, being able to respond quickly is a real strength for investor coalitions or coalitions generally. So you do have to set out at the beginning clear policies and processes, roles and responsibilities, what interventions need to be run past the whole group and go through their individual governance sign-off processes. Where are the issues where we've got an agreed position, we've got an agreed approach, and actually that can be something that can be responded to much more quickly and involving a smaller group of decision makers as well. So we really believe in the power of investor collaborations or collaborations elsewhere across the industry, but it's important not to go into something like that lightly, particularly if you're setting something up.
Thank you. That's really insightful. Regarding DCSS, what are the prospects for the planned listings of major AI firms? I think that's something that's on a lot of people's sort of radar at the moment. And how do you work towards strong shareholder rights given the competition for those listings?
Dual class share structures, we call them unequal voting rights as well, to try to turn what can be quite a dry sounding topic into something that is a little bit more intuitively accessible for people who don't have a background in corporate governance like you and I, Stuart. Dual class share structures are a real issue. And of course, as you say, they are very prevalent amongst founder-led firms where the person who set it up, it's their baby, and they want to keep control as much as they possibly can. So they give themselves these disproportionate voting rights where they have voting influence totally out of proportion to what can sometimes be a very minor economic stake in the company. Of that, of course, means that independent shareholders, their views, the views of long-term investors like Railpen, are not heard as effectively as they might be. So that's a real issue for us. And we will continue to see, I'm sure, tech firms, founder-led firms, often in the tech space, listing with dual class share structures. And one of the ways in which Railpen tries to tackle this through its coalitions is to engage with these companies way before they've even made a decision to list and where they're going to list and what their capital structure is going to look like, because we want to dedicate our resource to influencing when a company is being open to influence. And it's often the case that when a company lists with dual class share structures, the horse has bolted. It's too late. So for Investor Coalition for Equal Votes, which is a 4.5 trillion global coalition co-founded by Railpen, chaired by Railpen, for that we have various phases of activity. So we engage with companies a good few years before they are thinking about a listing. We engage with the people that the companies are going to be listening to at that stage. So that includes the investment banks, it includes the legal advisors. And we also are beginning to engage more with private equity and venture capitalist firms, those early stage investors who, again, will be influential in supporting companies to think about what their final listing, what their final capital structure might look like. And there is evidence to show that even though dual class share structures, unequal voting rights is a really entrenched and complex issue, that the work of Investor Coalition for Equal Votes, ISEF, has had an impact in persuading companies not to list with dual class share structures where they thought they might otherwise do. And we can't, of course, engage with absolutely every company around the world that is likely to list with dual class share structures. So that takes us back to that systemically important companies piece that I mentioned earlier, where we think about those IPO firms that are going to go to IPO, whose activities and their capital structure and how that lands in the market is going to be watched by every other company around.
Wow. I mean, one of the things that we've got coming up is private markets. So lots of lessons there, I think, for that as well. So thank you for sharing that. Much of your SFM engagement plan involves engagement with not just the investees or policymakers, but there are other elements of the financial sector. Mm-hmm. What difference in approach does that entail?
Of course, when you are trying to achieve system-wide change, it is important that you think about the system, the ecosystem, the investment chain as a whole, and don't just think about companies or don't just think about policymakers, as more and more investors are beginning to do. We like to work with asset managers where we can. So we think that asset owners do have a privileged role in the investment chain because they are the financial actor whose needs are most closely aligned and purely aligned with the needs of the end saver. So we have this privileged bit at the end of the investment chain. But asset managers, they can bring huge AUM, they bring huge expertise as well, which is why we work with them through the Investor Coalition for Equal Votes and on other issues like our workforce engagement coalition as well that we set up a few years ago. And to encourage them to join us, having those antitrust provisions is really key, making sure that they feel comfortable talking honestly amongst people who might be their clients, sort of all the asset owners part of the same coalition or are already their clients as well, is really important. So creating that safe space is fundamental. We also like to speak to what we call financial market gatekeepers. So these are people who shape the investability or the accessibility of markets for different bits of the investment chain. That includes engaging with people like index providers, as well as with stock exchanges, and that's really a core focus for large parts of our sustainable financial markets world. And with them, when we're working with them, it's really trying to encourage them to understand that investors want to invest, they want to invest in high quality companies, and they are really willing to work with the financial markets gatekeepers in order to ensure that a particular market, like the UK capital markets, for instance, are as investable as possible. And then the final major group of stakeholders for sustainable financial markets is probably the audit firms, and the audit committees, are probably more business as usual, but working with the audit firms to try to ensure that there is a good investor audit firm dialogue on audit issues. Our sense, and this has been validated in some of those many reviews on audit quality in the UK that happened a good few years ago. I think the situation has improved since then, certainly, was that sometimes audit firms need to be reminded that it is the shareholder that is the ultimate client, and not the company. And conversely, investors need to be reminded that although not many of us are audit experts, and although audit and audit planning might seem very, very, very dry, it is really important. So Railpen sees itself and some of the work it does in bringing people together as having a particularly important role in supporting that channel of communication between audit firms and other participants in the audit ecosystem and shareholders.
Great insight there, thank you. Policy engagement plays a growing role in the SFM engagement plan. What are the skills, tactics, resources needed for asset owners to use this channel effectively, especially in the light of overall policy environment?
I always say that stewardship practitioners are actually really well placed to influence on public policy, because being a good steward of your assets relies on you being able to build good relationships, build trust-filled relationships, understand the pressure points and the desires and hopes of the company that you're engaging with, the entity that you're targeting, and all of those things are beautifully transferable to public policy. And weirdly, I did the jump the other way around. So I was a public policy practitioner. And again, those transferable skills I brought into my investment stewardship work. It's just a different group of entities that you are trying to influence. So I think as a stewardship practitioner, other people, asset owners and asset managers, are probably really well placed already to be engaging on public policy. I think one of the things that we underestimate as an investment stewardship industry is the need to think about messaging and think about crafting that messaging and even think about crafting that visual identity, because policymakers are very time pressed. They won't be the experts. And you need to ensure that what you're talking about mimics the language that they are using. It's why it was so important for us as the Governance for Growth Investor campaign to actually have growth in the primary messaging, because that is a UK policy-focused campaign trying to encourage policymakers to recognise the evidence that good governance leads to greater economic growth. And of course, this is a UK government that is absolutely passionate about achieving good growth. So it was important for us to mimic some of that language, not only into our messaging, but even into the name of the coalition itself. I would encourage people who think, oh, I can't set up a policy coalition, that's too much, everyone has different resources at their disposal, to really work through their membership associations. Having worked at some of our industry membership associations myself, we recognise, I remember how much we wanted our members to proactively come to us, as well as us going out to them to ask them for views on particular things. We love, speaking with my former membership association hat on, we loved having people come to us and feed through their ideas. So that is really open to all the investment stewards who will no doubt be members of many different membership associations to get involved in a low resource way in public policy influencing. And the final thing I would say is that most asset owners, of course, all the asset managers, I'm sure, will have their own internal government relations and policy resource. So do work closely with them. We at Railpen work hand in glove with our own external relations, our government affairs team, as well as our external communications team on all of our public facing work to ensure that we are speaking with one voice and in a way that's aligned to all the other policy work that is going on along Railpen, as well as, of course, to get their expertise in terms of refining our messaging and our objectives.
Wow. Caroline, thank you so much for taking the time to talk with us. I could literally listen to you all day. And I have so many more questions that I could ask you. I know that you haven't got, you've given us enough time already. So maybe we can get you back another day and we can ask you a bunch more questions.
Really happy to. Anytime, Stuart.
Brilliant. Thank you.
No, thank you.